Hello everyone, welcome to my channel. Today I'm going to show you why having both pension plan and 401k is better. Um, Having pension plan, you can shield money and tax defer your money. When you have pension plan, you will be offered to have also 401k and 457 in addition to the pension plan. Now you will contribute to the pension plan and the employer will deposit their percentage into your pension plan on your behalf. In addition to the pension plan, when you retire, you will use your contribution first, then the rest of the money is provided by the pension plan. So hypothetically, you will use up your pension contribution in 10 years after retired, then the next 20 years of your life will be depend on the pension plan money because you use up all your contribution into the pension plan already and the rest of the money come from the pension plan alone. Now, let's look at the lifetime monthly payment benefit. Your survivor and beneficiary will get a lifetime monthly payment upon your death based on your selection. You get paid for life with your pension and could pass on to your survivor and beneficiary for life as well. So this is just a pension plan alone. And for having all of them, 401k and 457, you actually can shield your money away and you don't have to pay tax. So remember, having a pension plan, 401k and 457 all together, you can actually decrease your annual income and you can do some more and invest more into those retirement accounts. So this is the benefit of having pension plan. And also you can have 401k. You can do your own, select your own investment, pick your own index fund if you want to for 401k, but the pension plan you can't do it. They will have to pick and then they do investment for you. But having both is very beneficial. One is you can control and then do the investment based on your selection, and the pension plan they will do the investment for you. And sometimes in a contract with the union, sometimes they have to like make at least 6% return for your money that you put it in into the pension plan. So this is the benefit of having both pension plan and 401k. There are so many benefits having pension plan. Having pension plan, you can also open on a account 401k and 457. And now that you have three accounts all open, you can tax defer your money into a pension plan, also 401k and 457. Before we start, we need to understand the definition of survivor. In this case, survivor are set by law generally in the following order of priority. So number one, the priority number one is your spouse or unregistered domestic partner. Number two, unmarried natural or adopted minor children and unmarried disabled children. Number three, economical dependent parent. So if you have a spouse, that is your survivor priority number one. And then your unmarried children, either biological or adopted, is your number two survivor. And number three survivor is your parent who is depend on you economically. And let's look at the also the definition of beneficiary. Beneficiary is a person who choose uh, is a person you choose who will receive a monthly payment after your death. So this means that you can pick anybody. It could be your blood related, could be your nephew, your uncle, your niece, and then it could be not the person related to you. It could be your neighbor, your friend, or the person who helped you and you think that you love that person and you want them to have something from you. And beneficiary also could be, organization, a charity. So there's so many things that you can pick as your beneficiary, and you can pick a person, you can pick a organization, or you can pick a hospital. So this is a retirement estimate calculator, pension plans through CalPERT. CalPERT is a public employee that working for the state. So we're gonna try to do the estimate how you're gonna get paid when you retire, and you want to give it to your survivor and you want to give it to your beneficiary. Let's do the date of retirement that you will planning to retire. In this case, we're gonna do an example 2045 to retire. Um, this calculator will actually provide us some information how much we will get paid when we retire. So in this case, the scenario, the person will get paid $10,000 a month. Now this is the final compensation, and normally they count the higher pay within 12 months, and they use that as the final compensation. If within 12 months you make less than $10,000, of course, your final pay will be less than $10,000. But in your 12 months you make the higher pay is $10,000, then your final compensation will be $10,000 a month. Now let's click continue, and in this case we're going to select full-time employee. And then in this case, we're going to say no. Do you want to include unused sick leave? In this case, we're just going to say no. And now in this section right here, it to add your survivor. So the definition of survivor is someone that is legally bound to you. In this case, we're going to put, do you want to include a survivor? We're going to put yes, because we want to see the example of estimated payment, monthly payment to the survivor. And for the beneficiary, how many beneficiary do you want to include? Let's see, we should say just one beneficiary. So they also do explanation what is the beneficiary. A beneficiary is a person you choose who will receive a monthly payment after your death. Your monthly benefit payment is based on both your life expectancy at retirement and your beneficiary life expectancy. The younger your beneficiary is, the greater the reduction will be to your unmodified allowance. So they explain it to you what's a beneficiary. Let's continue. Now, because we have only one beneficiary, we're just going to be hypothetically that this person, the beneficiary, is very young. And let's just say 2018. So the person right now is only 2 years old, and we're going to give the person 25% of the money they're going to get every month upon their death. You can do both the percentage, or you can a dollar amount. You can give $500 or $1,000 a month to the person. But in this case, we're going to choose 25%. And we're going to continue with the calculation, calculated estimate. So the estimate result now we can see a standard option, retirement option, unmodified allowance. It's provide a higher monthly allowance pay for life. There is no continuing monthly benefit to a beneficiary and no return to unused member contribution upon your death. So this means that your beneficiary will not receive any money. And for this reason, that's why you receive a higher pay. And also it say that no return of unused member contribution upon your death. So that means whatever you put it in, when you die, you want your money, if you did not use all up your money, the contribution that you put it in, then they will not give out to your beneficiary. And however, in this case, this will pay to your survivor, okay? And you will get paid every month. When you retire, $6,000, $6,359. Your survivor, upon your death, will receive $3,179 until this person, the survivor, die. And another scenario is return of remaining contribution. So this, we need to look at the definition of it. Upon your death, provide a lump sum payout of any remaining member contribution in your account to one or more named beneficiary. This option does not provide your beneficiary an ongoing monthly benefit, so they pay a lump sum to your beneficiary, okay? So, but you will receive, your monthly benefit payment doesn't end when your contributions are exhausted. So when you use up all your contribution, now you continue to receive money from the pension plan. Your total contribution, $255,000, will be reduced by $1,845 for each month that you receive on allowance. Your contribution will be reduced to zero in approximately 11.55 years. So most of the typical contribution that you put into a pension plan, you most of the time you use it up by 11 years. And let's say you retired at 55 years old. So 11 years you have 60, plus 11 year from the 55, say 55 plus 11, so you will be 66 years old. So by the time you age 66 years old, your money will be run out. Your contribution that you put into a pension plan will be run out. And this case, after 66 years, now you're 67, 68, 69, until you're 90, you will receive the money from your pension, okay? Because you already used up your contribution to the pension already. Now the money that you receive after you 67 years old, it's from the pension that your employer will put it in for you. So it could be 25 years. Let's say you live up to 90 years old. So the rest of the year that you're alive, you'll get paid from the pension plan. This is not your contribution money that you put it in because you already used up all the money already. Now your survivor, and this return of remaining contribution, your survivor will receive $3,179 upon your death for the life of the survivor. And let's see the 100% beneficiary. The 100% beneficiary is provide 100% of option portion of your ongoing monthly benefit to your named beneficiary upon your death. Upon both your death, a lump sum payout of any remaining member contribution in your account will be paid to one or more named secondary beneficiary. So you still alive, you will receive $5,363 every month until you die. Okay? And your beneficiary after your death will receive $2,183 every month. And your survivor also will receive $3,179. You can see this column, the survivor will always remain to have the same amount of money every month after you die. Okay? And for you, if your beneficiary died before you, so let's see, this is you selected to have, pay to beneficiary, but for some reason your beneficiary died before you, you will be getting this amount instead of the $5,000. You will get $6,359. So, I'm sorry, let's see, you will get $5,363. Okay, so this is 100% beneficiary. If the beneficiary died before you, you will still have the same money. But let's look at this one right here. 100% beneficiary will allow an increase. So when this one is the same concept like the first one, but this one, if you're because it's allow an increase, when your beneficiary died before you, you will receive this amount every month. Because when it starts, your beneficiary is still alive, you get only $5,360, and your beneficiary for your beneficiary after your death will receive $2,180, and your survivor still remain receiving the same amount, $3,179. But this money right here is one, if your beneficiary died before you, you will receive $6,359. Now let's look at the 50% beneficiary. 50% beneficiary is provide 50% of the option portion of your ongoing monthly benefit to your named beneficiary upon your death, upon both your death. A lump sum payout, any remaining member contribution in your account will be paid to one or more named secondary beneficiary. So this one you will receive a little bit increasing because this one is 100%, okay, to beneficiary. This one you only do 50% to your beneficiary. So you will increase your monthly payment to yourself while you're alive, $5,768. And your beneficiary, when you upon your death, he or she will receive $1,294, and the survivor will receive $3,179. Now, if the beneficiary die, then you will remain the same balance that you're gonna get every month is $5,768. Now let's look at the 50% beneficiary with allow an increase. So this case provide 50% of the option portion of your ongoing monthly benefit to your named beneficiary upon your death. If your beneficiary died before you or you have another qualifying event such as a change in marital status, your benefit will increase to the unmodified allowance. So for the 50% beneficiary with allowance increase, you will receive every month $5,766 while you're alive. And then when you die, your beneficiary will get $1,293. Your survivor will still gonna get upon your death. Your survivor will still get $3,179. But if your beneficiary died before you, now you will receive a monthly payment to you while you're still alive is $6,359. So this is all the option that you can select through the pension, and your beneficiary will pay for a long time until they die. Okay, if they're younger, they're gonna get paid longer. So also as well as you, if let's say in this case you retired at 55 years old, so you use up all your contribution into the pension plan 11 years, so you will be 66 years old. At 67 years old, you will use the money from the pension plan that you did not put it in. This is straight money from the pension plan that provided to you up until you die. And then it will benefit to your survivor until the survivor die, and also the beneficiary if you choose to have a beneficiary on this pension plan upon your selection. Okay.